We are witnessing an anomaly in the silver market that shouldn't be mathematically possible. Spot silver just shattered its all-time highs. It's trading near $90 an ounce. The physical metal is disappearing from vaults in London and Shanghai. The premiums are skyrocketing. But look at your portfolio. Look at the mining stocks. They are flat. Some of them are down. The companies that actually own the metal in the ground are trading as if silver is still $25. The market is screaming at you that this rally is fake. The mainstream media is telling you to take profits, but I'm here to tell you that this disconnect is not a warning sign. It is the greatest arbitrage opportunity of the last 50 years. We are seeing a flush, not a top. The elites are shaking you out of the equities before the violent repricing begins, while investors are chasing the metal. The real 10x gains are sitting in the mining stocks that Wall Street has forgotten. But there is a catch, a hidden supply bottleneck in something as boring as nitric acid is about to shut down half the world's refining capacity. When the news breaks, the miners who can actually deliver the goods are going to moon the rest. Are you holding physical silver, or are you gambling on the miners? Let me know today. We are answering the question everyone is asking. If silver is mooning, why are my mining stocks dead? The answer lies in a concept called operating leverage, and a secret crisis in the refining supply chain that almost nobody is talking about. Let's address the elephant in the room: the volatility. We just saw silver rip to $1.94 and then crash $10 in a single day. The bears came out instantly. It's over. They said the bubble popped. But listen to Lobo Tiggre. He is one of the sharpest analysts in the resource space. He calls this a flush, not a top. What does that mean? In every major bull market, right before the parabolic move, there is a liquidation event. The banks smash the price to trigger your stop losses. They need your shares. They need your position. Tiggre points out that despite the record spot price, the sentiment in the mining sector is at rock bottom. That is a divergence in a true bubble top. Everyone and their Uber driver is buying junior miners right now. Nobody wants them. This lag is historic. Usually, miners lead the metal when miners lag. It means the market doesn't believe the price is sustainable. The market thinks silver is going back to $30, but we know it's not. We know about the deficit. We know about the solar panels. We know about the military demand. So, if the price stays here, the miners have to catch up. And when they catch up, they don't just walk. They sprint. Why do I say the miners are the next leg up? It's simple math. Let's say a mining company has an all-in sustaining cost, AIC, of $25 per ounce. That means it costs them $25 to get the silver out of the ground. When silver was at $30, they made $5 profit per ounce. $30 price, $25 cost, equals $5 profit. Now, silver is at $90. Did their costs go up? Yes, maybe to $30 due to inflation, but look at the profit now. $90 price, $30 cost equals $60 profit. The price of silver went up 3x from $30 to $90. But the miner's profit went up 12x from $5 to $60. This is called operating leverage. The market hasn't priced this in, yet the quarterly earnings reports haven't come out yet. Wall Street is asleep. They are looking at last year's data when these companies start. reporting Q1 2026 earnings with 1,200% profit growth. The algos are going to buy everything in sight. We are sitting on a powder keg of earnings. Surprise, not all miners will survive. And this is where the hidden truth comes in. Here is the alpha that you won't hear on CNBC. The price of silver isn't just rising because of demand. It's rising because the supply chain is breaking. The refining crisis. Nitric acid. You can mine the ore, but you have to refine it into 0.999 pure bars. To do that, you need chemicals. Specifically, you need massive amounts of nitric acid to separate the silver from the dross. There is a quiet global shortage of industrial acids right now due to the energy crisis in Europe and supply chain wars in Asia. Refineries are warning they can't run at full capacity. If you are a miner with dirty or complex sulfur and you can't get it refined, your stock goes to zero. You have rocks, not money. But if you are a miner with clean ore or your own refining capacity, you possess the only thing that matters to declining ore grades. Look at the data from Mexico and Peru. The two biggest silver producers. The easy silver is gone 10 years ago. A good mine had 400 grams of silver per ton of rock. Today, they are excited about 150 grams. They are moving tons of earth for a few flakes of metal, this means costs are rising exponentially. The marginal ounce of silver now costs $40 or $1.52. Produce this creates a floor under the price. Silver cannot crash back to $25 because the mines would shut down. The physics don't support cheap silver anymore. The final piece of the puzzle is the arbitrage right now. Silver in Shanghai is trading at a $10 premium over London. This is the Shanghai squeeze. The Chinese are draining the physical vaults of the West. They are buying silver in London, flying it to Shanghai, and selling it for a profit. This drains the COMEX, it drains the LBMA. The inventory that the paper traders rely on to suppress the price is vanishing when the inventory hits critical lows. The paper shorts, the banks panic, they have to cover, but who do they buy from? The miners. The miners hold the keys to the kingdom in 2026. The miner becomes the master now. A warning: do not just go buy an ETF like SIL or SILJ and hope for the best. Why? Because those ETFs are full of companies operating in dangerous jurisdictions. Mexico is nationalizing resources. Peru is facing protests. If your miner is in a country that wants to steal the mine, the price of silver doesn't matter. You need to look for safe jurisdictions. Canada, USA, Australia. High grade. They need less energy to get the metal refining access. Do they have a path to market? The lag is your opportunity to cherry-pick the best companies while they are on sale. The herd is selling because they are bored. The smart money is buying because they are doing the math. Flush is almost over. The weak hands are out. Lobo Tiggre is right. This is not a top. This is the refueling station before the rocket launch. Year 2026 is going to be the year of the miner. The metal has moved. The equities are nectant. Let the volatility scare you out of your position. If you hold the line, you are positioning yourself for the kind of wealth that only comes once in a generation. This video opened your eyes to the operating leverage play. Smash that like button, subscribe to Wealth On, because next week we are going to name the specific jurisdictions we are avoiding. Comment below. What is your number one silver mining stock right now? Share your ticker symbols. Let's compare notes. Stay sharp, stay stacked, and I'll see you in the next one.